Hello and welcome to Business Management Chapter 8 Ongoing Evaluation of Small Business. So what's ahead? This chapter is all about evaluation. Chapter 8 focuses on strategies used to undertake ongoing evaluation of small business, including key performance indicators, practices that contribute to ethical and socially responsible management with respect to decision making, planning, and evaluation. Success or failure. Businesses will either succeed or fail. Between 60% to 70% of all new businesses will fail within a few years. Approximately 100 Australian businesses will close its doors per day. There are many reasons why businesses fail, but one main reason is financial failure. And that is why it is essential to pre-plan and evaluate the performance of your business using what we call Key Performance Indicators or KPIs. Have you ever heard of a business going bankrupt? Yeah, many businesses fail. And these can take two forms. Bankruptcy. It is a legal process that is enforced by the courts, whereby the assets of the business owner are sold and proceeds are distributed to creditors or organisations that is owed money. Businesses can fail and go into insolvency. This is when a business closes itself down, as it cannot pay its debts or it doesn't make money. Assets are then sold to pay the creditors. So bankruptcy is when the courts take over and assets of the business owner are sold, and insolvency is when the business itself decides to close down because it cannot pay its debts. So why do businesses fail? Businesses fail due to the following reasons. Number 1, managers cannot perform their jobs well. Number 2, managers and employees are not able to carry out their duties and are incompetent. Or businesses can fail due to poor management. So for example, with the first one, managers cannot perform their jobs well. Maybe they aren't skilled enough or they haven't had undertaken enough training. With the second one, managers and employees are not able to carry out their duties and are incompetent. It might mean that managers just don't want to do their job. And the last one, poor management. That's maybe because some managers are not able to identify problems in an organisation and to manage them well. So how to evaluate the success of a business? We first look at the business efficiency. Now that's the key word there, efficiency, and I think we all know what it means. So when businesses minimise the use of resources, and we learnt about what resources are in Chapter 2, this results in production costs improving, which results in productivity. And this then causes overall efficiency. It is the role of management to create the environment in which a business operates the most efficiently. So just to go over that again, business efficiency is when businesses minimize the use of resources. This results in production costs improving, which results in productivity and overall efficiency. So here's a diagram just to explain this whole process. So when a business works quite efficiently, this causes or creates the environment for improved production. So more things are made quicker, which then results in more profit. The more profit that is generated would mean that an organisation becomes more efficient. So that's what efficiency is. In order for a business to reduce its costs, it needs to look at the following 8 basic categories of resources. Okay, so number 1, we have cash and funds. Cash and funds are money readily available to buy other resources. Cash flow refers to money coming into and flowing out of the business. Number 2, working capital. This is the amount of cash reserves a business holds to meet short-term commitments. What about people and labour? They are the workers in the business, and we know all about them. Then you've got capital assets. They are tangible or things that you can touch, like property, that cannot easily be converted into cash, and that is usually held for a long period, including property, machinery, and so on. Then you've got raw materials. They are inputs to the production process, and we've been through raw materials before. Component parts. Component parts are manufactured parts that go into production of goods and services. You've got time. That's a non-renewable resource, meaning that once time passes, you can never get even a second of that time again. Okay, and then you've got the last one, expertise and knowledge, which are valuable resources to any business. Okay, here's the fun and exciting part. It's time for you to complete activity 8.2, which is on page 131. Business effectiveness. A business can measure its effectiveness, or success, by looking at how well it achieves its objectives. Some business objectives could be, number 1, financial objectives. Objectives that are directly related to the monetary aspect of the business. So, for example, profit and cost levels are examples. Okay, then you've got non-financial objectives. They are not directly related to the monetary aspect of the business. Examples are to increase staff morale, improve environmental performance, or to adopt socially responsible practices. So in order to measure the success of a business, we have to look at its objectives. And there are two types of objectives. Number 1, financial, so how much money or profit an organization or a business makes. And the second one is the non-financial objectives. So I've just explained or given an example. They could be to improve staff morale, like how happy staff are in the business. It could also be to improve the environmental performance of a business. And to adopt socially responsible practices. Okay, now we're looking at key performance indicators or KPIs. They are criteria or measures that are used to evaluate, so here's that word again, evaluate, the performance of an organisation against its stated objectives. So we've talked about objectives, financial objectives and non-financial objectives. The efficiency in the use of resources, which we've also touched on just before. KPIs must be measurable over time. There's no point in having key performance indicators if you can't actually measure them. This is like what I was talking about the other day in commerce with the SMART criteria. Goals need to be able to be measured, and there are different ways of doing that, which we are going to look at very soon. So just to be clear, KPIs are tools of measurement that are used to evaluate the effectiveness and efficient use of resources in order for a business to be successful. So KPIs basically tell us how successful a business is. Okay, steps to developing KPIs. Number 1, establish organizational objectives. Plan how these objectives will be achieved. Develop KPIs to measure progress. Non-financial indicators. Okay, so we can measure the successfulness of a business by looking at level of staff satisfaction. Okay, this means looking at how happy workers are in the business. Are they constantly sick? Is absenteeism high? Is staff turnover quite high? Are people leaving because they are not happy? We could also look at the environmental impact. It is becoming common for businesses to set themselves objectives in relation to their environmental impact. This may be reflecting the business's own philosophy. It may also be in response to laws passed by governments that are designed to protect their environment, or simply because consumers express a preference for dealing with an environmentally responsible business. It is important for businesses these days to take into consideration the impact that their business has on the environment. Another non-financial indicator is social responsibility, which we've been through quite a bit already. Levels of social responsibility. Businesses are increasingly in the public spotlight for their performance in the area of social responsibility. The Australian community is increasingly demanding good corporate citizenship. Measures of levels of social responsibility could be business involvement in sponsorship of worthy causes, the adoption of programs to employ disadvantaged groups, or simply the reputation of the business in the local community. So people are becoming more aware of how a business contributes to society and whether they make a positive impact. Now to another fun activity. Complete activities 8.3 and 8.4 on pages 135 and 136 to 137. Okay, now it's time to look at the financial performance indicators. Okay, so we've got assets, and all of these can be looked at on page 132 to 133. So assets. Any item of economic value owned by an individual or corporation, especially that which could be converted to cash. Now, some examples are actually cash, securities, accounts receivable, office equipment, real estate, a car is an asset, and also property. Okay, then you've got gearing. Gearing is the percentage of company assets that are financed by borrowing compared to the proportion financed by owner's equity. So how much is still being paid off? You've got liabilities, an obligation that legally binds an individual or company to settle a debt. A liability is recorded on the balance sheet. Examples are accounts payable, taxes, wages. Current liabilities are debts payable within 1 year, while long-term liabilities are debts payable over a longer time. You've got profit, the positive gain after subtracting all expenses from amount taken. So basically, what is left over after all the expenses are taken out. Okay, then you've got net profit. Net profit is calculated by subtracting the total expenses from total revenue, showing what has been earned or lost in a given period of time. It's also referred to as net income, net earnings, or the bottom line. So basically, it is what money is made after all expenses. You've got net sales. Gross sales revenue minus returns and discounts. This is shown in an income statement, the real value of what you have sold. And you've got revenue. Revenue is the total amount of money received for goods sold or services sold over a certain time. It is calculated before any expenses are subtracted. Net income can be calculated by subtracting expenses from revenue. So basically, how much money you collect. You can have a read of this on page 132 to 133. What is the triple bottom line reporting? Many organisations and businesses these days want to promote transparency in their organisation. So they report on its financial, social, and environmental performance. So triple bottom line reporting basically is when a business reports on its TBL and they are willing, sorry about that spelling mistake, to be accountable to all stakeholders for environmental and social performance. By the way, just letting you know that it is 9:37 a.m. on a Sunday morning and I am doing this video for you guys. Here's a lovely little diagram here, economic performance. social performance, environmental performance. If all of those areas of performance are working quite well together, then the business is going to be quite sustainable. Okay, meaning it's going to be hopefully a success. Benchmarking. Benchmarking involves a business comparing its performance to industry standards or market leaders in the industry. One very quick example is that if Inspiration Cupcakes were to do some benchmarking, they could compare themselves to industry leaders like Sprinkle Cupcakes or Cupcake Central. So basically, it's sort of doing an experiment to see whether a business is up to date with its industry standards and whether it competes quite well in the market with leaders in that particular market. So here are the common KPIs that a business or organization can use to measure its performance. So you've got profits. Obviously, if an organization makes a lot of profit, it's performing quite well. With the profits, you've got the cash flow, so how much money comes into the organization or the business and how quickly. Market share, you all know about market share. We've discussed this before. I think Brother Dean's talked about this in one of his videos. Okay, so how much of the market an organization actually holds. The level of social responsibility. So is this organization quite involved in the community? Do they have environmentally friendly products? All of that. And of course, benchmarking is looking at other businesses in the same industry and to see whether basically, it's to see whether that organization is up to standard with industry leaders in that market. Okay, now we come to the conclusion of this very wonderful video. I'm sure you've all enjoyed it and had a very lovely and excitable time watching it. So we need to complete the chapter summary questions that are located on page 138, questions 1 to 7. We also need to watch this video many times and read our textbook, chapter 8, and then obviously you've got your quiz this Tuesday. And that will be the conclusion of our Term 1, Unit 1, Studies on Business Management. I'm sure you've all had a delightful time in our class and also an equally delightful time watching our fantastic videos. I must say, I think this video is one of the best ones that are out there. Probably Sarah and her friends, Rafia and Azo, have created the best video, but this one here is not far behind. So thank you for listening, and I'll see you later on.